All right, welcome to Be the Market Expert. And to kick this thing off, want to talk about new construction. And so this is um, new construction across the United States, and it says percentage of active listings that are newly built homes according to Parcel Labs. And so as we're going through this, and we're going to skip through it, I just really just want to look at these charts. And so these are just right, just as it says, visualization of highlights that are important aspect levels of new construction. So what's interesting, we look at this thing, this is percentage of active listings that are newly built homes. And let's take a look at this. In the United States, especially in the United States, we're less than 10%. We're somewhere around 7% of all active listings in the United States are going to be new built listings. But if we were to look over here and we just kind of look over, you see Florida, South Carolina, Georgia, North Carolina, Texas, Florida, North Carolina, right? You kind of see this thing over and over. There's Alabama, Arizona, Arkansas, New Mexico. But it's kind of interesting, like north of 20% of the homes in just one particular city, right, on the far left outside of Florida, are newly built homes. And this is where it gets kind of interesting. Like, as we're seeing things, we're seeing that these mean that these homes are sitting on the market. I think that's the biggest thing that we have to keep in mind when we talk about active listings. And we talk about something that's in a chart like this. Like, we're saying that there is such an exorbitant amount of data points that we're actually going to put together a graph to show it. Like, someone didn't just like, hey, I'm going to do this on a Monday and let's just see what we come up with. No, like, this means that there has been weeks and months worth of inventory on the market in a particular subject, particularly new built homes, where they actually compile this data and put it together. So as we're thinking about this and we're thinking about the market that we're in and the market that we're going to, on the past couple of conversations that we've been having, we've been talking truly about these new builds, and the permits are slowing down as well as the housing starts have started to slow down, right? So we're seeing less permits being pulled. And on top of less permits being pulled, we're actually seeing less starts on these properties. And we also have to keep in mind that on a multifamily, it takes about 22 months. So we're talking about like apartment buildings, condo buildings. It takes 22 months for them to finish. That's why, like, we drive through Arvada or insert whatever city here, and we're seeing these big multi-rise complexes that they've been just kind of going and going and going. And like, some of them are starting to come to fruition. Like, if we're looking over here at this Kmart project in Arvada, and it takes about 6 to 7 months for a new build, once permits are built or that have come in, for a single family residential home to be built. This is truly showing that these homes have been sitting on the market for a very long time, and it's unevenly yoked. And when we're talking about prices and how prices have not fluctuated too much, even considering that interest rates are sitting where interest rates are, right? I think that's the biggest thing we have to keep in mind. Interest rates are still high and prices are not really coming down. Yes, we're seeing some corrections in some different places, but in the grand scheme of things, they're not coming down to where they truly matter uh, in any real effort. So if we scroll down a little bit further, this is where it gets interesting. So shift in home builder stock since December 31st, 2019. So if we're looking at this thing, here's 2019 on the far left, just right before this 2020, obviously. And we can kind of see the S&P 500 as this black line. And let's just kind of like pace with this a little bit. So everything's kind of in line when we're looking at 2019 data, 2020, right? We knew things got weird here. And we're getting all the way to January 2024. So rear view facing data. We're looking at this and look at all these home builders, right? We got MI Homes, Century Communities, Toll Brothers, Lennar, DR Horton, Meritage, Taylor Morrison, KB, right? Some of the ones that we're very familiar with in Colorado. And like Century took off. This is gangbusters, like, we're looking at this. But if we're tracking this data, they had this big spike, and they're saying that last year was the biggest benefit that they've had. But if we're going And now we're getting back onto this side of 24, right? This is where we're looking at. So this side of 24, the data's going back down. So the stock's going lower. This is why this is important. We just looked at this and we're seeing that they're sitting on inventory. Builders are sitting on inventory right now, which is not what builders want to do. Builders do not want to be left holding the bag. This is when we talk about the Big Short, right? Too big to fail, and we're talking about all these different things. This is why builders pulled back production, is because they had a lot of inventory out there that was not selling, and so they started scaling it back. And that's why we don't have as many homes that we should be having, is because builders stopped building because they're a for-profit company. Builders are a for-profit company. They're not the March of Dimes, right? They are not a charity. So we're looking at this and we're seeing these big spikes, and they're doing well. They're doing well. We do know that they started pulling back permits and that they're not building as much. The starts have slowed down. And this is why they're not making as much money. And a couple of different things with this, right? And probably the biggest one is the cost, right? Cost associated with them building houses. And it's kind of interesting. If we were to talk about just the cost of money, we do know that the cost of money is actually why these new builds did so favorably, is that they went through and they were actually able to be their own bank in a lot of circumstances. And they were able to give more favorable rates in the resale market. Well, on the other side of that coin is that they're actually having to go out and they're having to pay tradespeople. They're going and they're having to buy materials and do all these other different things. And that is very, very expensive. So that's why they're slowing down, because not as many people are going out and purchasing, and they can only raise the prices as much as they can raise the prices for consumer demand and what the general public's willing to purchase these properties for. So as we're seeing that 20 north of 20%, here we're at 15, we're at 10, we're at 5%, and national right now, national is around 7%, that we can actually see that they're actually sitting on the market longer. These are holding costs. They're not able to give the shareholders, the stockholders, the value that they were giving them last year, the year before, the year prior to that. And so now they're having to slow down. This is why we have to keep this in mind. There's going to be less and less inventory on the market. And when we go into a situation where interest rates do start to come down, even though we've gone through a full half of a year at this point, right? We're in July. This is July 2nd, and we haven't seen interest rates go down. No, the rate cuts have come to fruition. And honestly, like after the debate, we actually saw the rates actually go up a little bit. But as we're looking at this thing, the new builds are not going to be our savior. There's going to be less product on the market. And if interest rates go down, which they should, if interest rates go down, we're only going to have really the resale market to rely on, which means that home values aren't coming down anytime soon. Less new builds, the resales that are out there, and interest rates coming down. While this won't truly look like 21, there will be a inventory constraint to the point to where we will see prices stay elevated at some level. So interesting data to kind of look at to start this thing off. Percentage of the active listings are going up, especially in some of these markets, right? Florida, South Carolina, these ones, Texas, like these are the ones where we did see these giant booms. And so when we're going through and we're looking at these different things, there's really no surprise here. And these guys are actually probably gonna have some of the bigger corrections as we're going through, because as inventory's sitting, they're gonna want it off their books. And that's the biggest thing that we have to keep in mind. And that's why we have these corrections, is that at some point something's gotta move if like you're looking to get these properties off the books. As well as now that they're making less money, they have to do something. And right, we do know that overhead, as far as rents and far as employees go, this is what's going to happen. So as they're stop building, what we're going to see on the flip side of this is we're going to see people are start losing their jobs. And as people are losing their jobs, because inflation data has been coming down, I think that's the biggest thing that we've been watching the Fed, right? We've been talking to the Fed. We haven't been talking to the Fed, but people have been talking to the Fed, and the Fed has been talking about inflation data, inflation data, inflation data. Inflation data is down. We've actually been seeing the cost of goods go down. The other side of that, though, is that we have people that have jobs. People have jobs, and that's actually the numbers that they're looking at. So as we're seeing this, and we're seeing that these numbers are starting to go down, the next thing that we're going to start seeing is they're not going to be building as much. They're not building as much. They need fewer builders. They need fewer contractors. They're going to start letting people go. Then we'll actually start to see the labor market break a little bit because this is a lot of jobs. We'll see less people with jobs, and we'll probably start to see interest rates go down at that point. So, with that being said, let's jump into this, right? We're going to look at Logan Moshami data from Friday. Review facing data. It says new listing data is growing and prices still aren't crashing. That's the thing. Like, we are in such a weird area. We all went to real estate school and we were told, if interest rates are going to go up, that means that we're going to be more in a buyer's market and inventory and the prices will go down. And that's not where we're at. We're seeing inventory come onto the market. We're seeing high interest rates, and we're not seeing home prices move too much. Yes, there are some price corrections, but we're not seeing this bubble, the silver tsunami, this crash. We're not seeing any of that. We're just seeing motivated sellers saying, I have enough equity into this thing. This isn't the dollar amount that I really wanted, but I'll still make money if I sell for X because I need to. Housing inventory is growing, but national home prices aren't dropping dramatically. As the recent S&P CoreLogic Case Shiller Index clearly show, it says why the rule of supply and demand economics always end up winning, and weekly new inventory data is key. And as we're looking at this thing, it says new listing data is growing year over year, but it will be the second lowest new listing data ever recorded in history. Think about that, everyone. Like, we are real estate agents in a time right now, the second lowest time ever for new inventory hitting the market. And that's where we are right now. And we do know it's interest rate driven 100%. If I sell my house, right, I am a believer in the golden handcuffs, right? Golden handcuffs say that I have an interest rate at 2-3%. And unless this home checks all my boxes, I'm probably not giving it up just to give it up and go somewhere else so I can jump into a 7% interest rate. So it says, looks like we won't see his minimum target of 80,000 new listings during the peak season, right? And we talk about the peak season, and we know that real estate is very seasonal, and the seasonality has changed a lot just through post-pandemic because of just interest rates and fluctuations and a lot of other things that are happening. But we still do have a peak season where, historically speaking, this is when we would have been gangbusters, and we go into the summer, people start slowing down, going into the school season, right? And so we did come short of what we were hoping for and what we kind of anticipated. And if we look at this thing, it says the seasonal peak period is in, and we don't even see extra selling this year that we did in 2022. And again, that makes a whole lot of sense because 2022, the second half is when interest rates started going up. And I think that's what we have to keep in mind, right? Interest rates, second half of 2022, that inverted hockey stick, like they went up very, very quickly. 2023, it stayed high while it dropped down. It's still hovering at a point where there's a lot of people that just aren't comfortable making that. And it is the motivated. The motivated are the ones that are driving all the decisions. So new listing data, we can look at this 2024, 70,000, 2023 was 61,000, and 2022, 90,000 homes hit the market. And again, this is kind of skewed data because if we were to look at this thing, you can see right here, check this out, right? Like, we have 2022 in the pink, we have 2023 in red, and we have 2024 in the dark red. So if we're looking at this, we can see that it tapers off the seasonality piece, as well as we can actually see interest rates, right? Interest rates started rising and people were still listing their houses, right? And so interest rates going up, people are still listing their houses. And so we got a lot of inventory sitting up here, really because no one was buying houses and we didn't know what was really going on. Like, a lot of us were in shock. That was the highest the interest rates have ever risen as quickly as they did in our civilization history. So as we're looking at this thing and we're going and we're looking at the data, yes, seasonality, we're absolutely seasonality right here. There's not enough inventory, right? New listings coming on, they're coming off pretty quickly. That also affects a lot of things. Like when we talk about homes on the market that didn't last a weekend or they were on the market for only an hour, like that definitely affects this. There's not enough time for that data to be scraped and put in here. So absolutely, there are components in here that skew this. But at the same time, this is a little deceiving only because homes were sitting longer, because this is when we saw rates get up astronomical and they were really just sitting and hanging out. But you can see this is where we are. We're kind of living in the middle. And as we follow this here, we'll truly see if we're really back into that seasonal market and following the seasonality of what we historically have seen. So coming soon, pre-listing data, which is also interesting. So here's a new checkpoint that we have. So these are coming soon because most of the nation has adopted in our MLSs some kind of coming soon. And we can see again, 2022, it was sitting in here. 2023, we're a little bit higher, which makes sense because interest rates were really, really high in this area. And we're right in the middle. So just for some context, if we were look at this one, right, we're talking that we're sitting somewhere between 80,000 and 100,000. And we can look through here and 80, 80, 84, 98, 87. So this is kind of where we live. So there's really nothing changed here, but here we go down a little bit further, weekly housing inventory data. And it says a grade for inventory this year is an A, right? And so for the fifth time this year, inventory hit his target level, right? And so they're looking to get this. It says getting 6 to 12 weeks of this is enough for him to be happy. And his rule of thumb has been that inventory should have some weekly positive prints between 11,000 and 17,000. So if we're looking at this thing, we saw last week inventory growth of 11,638. And again, we have to keep in mind that a lot of these people, anyone that's listing their house is motivated. These are motivated people, right? There could be a couple different extenuating circumstances, right? We could be talking about a very affluent seller that isn't really dependent on interest rates for when they're purchasing and selling houses. But I would say for the vast majority of the public, we have to go get some type of loan product to be able to go afford a house. And when we're getting that loan product, we have interest rates that we have to consider, right? And we're talking about 7%. And right now, guys, 7%, that's prime. That means that you are well qualified. You have a great credit score. All the characteristics, you're the perfect avatar. You get 7%. Most people aren't getting 7%. They're 7.25, 7.3, right? They're actually a little bit higher than that. And so as we're looking at this thing, we can actually look. Let's just go down to this visual representation. We're going up. More and more houses are hitting the market because less and less people are actually purchasing. And these motivated sellers are tired of waiting on the sideline. Like they've been waiting for too long at this point. They've been waiting for what the news has been promising them. The news has been promising silver tsunami, Airbnb bust, the crash, like all these different things, and they're not happening. These people are getting tired. They're putting their houses on the market. Here's 2020. We saw a significant dip. 2021, this is the no inventory, but this is also what we have to keep in mind. Here's the healthy market pre-pandemic, right? Everything that we're marketing up against is pre-2019, pre-COVID data. So as we're looking at this thing, right? So we're talking post-COVID, we're gonna live down here in this side of the sector of things. 2020 is obviously COVID, but as we're looking here, 2024, this is what's going to be interesting. What's going to be interesting is with the inventory levels of builders, as builders start to offload their properties, right? Because they're going to sell and they actually have bigger margins than the rest of us, right? And they're not driven by feelings, they're driven by dollars. And so they're going to get to a point where they're making some business decisions, whether they're going to offer some incentives to offload these products. Remember, they have shareholders to appease. While a reseller is going through the general public saying, like, oh, you know, it makes me happy. Zillow did this, my neighbors did this, I want X. These guys are bottom line. Like, what should be our ROI? How long do we want to hold on to this? If we are able to offload these properties and bring in some money, where can we redeploy that capital, right? Like, that's how they're thinking. So as that inventory is disappearing, interest rates start going down, right? Because they should. There's no reason why inventory or interest rates should not be going down with everything else that we're seeing. while I don't think we're going to see any massive cuts, we should absolutely see interest rates go down here towards the second half of the year. As we're seeing that, I'm very curious what happens here, because as it starts being not as constrained as it was with the interest rates, and it gets more affordable for monthly payments for people, I actually think we're probably going to live somewhere down here a little bit lower. Seasonality, yes. Inventory, with the resale market being our biggest inventory at that point, which it already is, but there's going to be less new builds at that point. Interest rates dropping, I think we could actually live closer between this 2021 and this 2022 marker, just because people are going to start feeling a sign of relief and they're going to be making quicker moves. Now we look at price cuts. And so this is what we were kind of talking about. Price cut, as we're doing this thing, we know historically speaking, 1/3 of all homes do a price cut. So right now we're sitting at 38%, and here we are. 37, it says the real number is 37.55%. Let's call it 38. 38% is where we're sitting on all homes taking a price cut right now. And we can see that's high. I mean, when we're talking about this time last year, 32%. When we're talking about this time 2 years ago, we're talking 31%. So as we're looking at all these different things, we need to just keep in mind that the interest rates is truly what's driving this. And we have the motivated people. The people that have put their homes on the market are motivated. They know what they're getting into if they have to go rebuy a house. They know that they're getting into 7%. So something is driving them to sell their house, and they can't just keep waiting. So they put their home on the market. They looked at the market data, and they said that this is what they believe that they should be doing, or they looked at Zillow. Who knows where they got their information from? But they are taking these price cuts, and we're seeing almost 40%. Historically speaking, 1/3, 33% of all homes take a price cut. We're sitting closer to 40% at this point. And again, this is the motivated. These are the people that need to sell. They got a job. Um, Family members are moving in, family members are moving out. There's someone was fired, someone was promoted, like something is happening to drive these people to put their home on the market, and they're needing to sell. So they're making these business decisions to cut these prices to get it happening. We look at this. It's also a new data point that they've been rolling out for the last couple of weeks, and it's pending home sales. And we can actually see that there are some in the queue, but we're sitting a little bit higher than 2023, and we are sitting lower than 2022 at this point. So this is good, right? We do want to see pending home sale data going through, and it says this is real time, and this is real time, right? Because we're not looking at closed data. This is actually people that are purchasing right now in this current market. We're seeing 397,000 people purchasing houses in this market under contract currently. And you can see this is higher than 2023 at this point, right? We can look through here. 2023, we're a little bit higher. We're still not as high as 2022. But again, this was all locked up with interest rates. Then we saw less homes hitting the market. So this line should maybe come up a little bit higher. Like as we're going through, yes, we're hitting some seasonality, but this got really weird. We were seasonality coming off of a really strong buying season and selling season. And with the seasonality right here, we may see these lines maybe intersect a little bit. We're not going to talk about the 10-year yield. And we're not going to talk about inflation. We're not going to talk about the mortgage spreads. We're not going to do any of that, but purchase application data. So here you go. They got a visual representation for us. And guys, like we're still in the basement. And I think that's the biggest thing, right? We're still looking at this, and this is the basement right here. Here's this line. And here we are. Here's 2023. Here's 2022. There is so many people on the sidelines. So if we want to know why inventory is going up, it's because we have motivated sellers that are finally like, I can't wait anymore. Some life circumstances happening. I need to sell my house. Yet we have these people right here that are barely putting their toes in the water, willing, knowing that interest rates are where they're at, to actually go through and pursue it. And these are motivated buyers, right? You have to keep in mind that these are people that truly at 7% with the price points the way that they are, like there is a life, something happening in their life that is moving them towards buying a house. So the week ahead, so this is the week that we're currently in. Remember, this is Friday. So this is going to be a crazy week. And first, it's jobs week. So Labor market. We've been talking about the labor market. The labor market is extremely important. The Fed has truly been hiding, and I mean that the Fed has been hiding behind inflation data. But inflation data has been coming down. It's been going down. It's been going down. It's been going down. The only thing that hasn't come down yet are jobs. It's the labor market. So if labor market comes down and starts getting what he's calling softer, right? He says it has been getting softer, but it has not break. If we get to a point where they're going through and they finally see people start losing their jobs, they're not seeing as much money into our economy, they will make lending easier for people, and they'll start dropping these interest rates. Now let's talk about interest rates. So here we are. We have a conforming 6.99. It went up. And we have FHA 6.7. It also went up. So this is just 1 month's time. And we can kind of look at this thing, right? So as we're looking in, here's June 3rd to July 1st. I can't get today's data yet, but here it goes. And we can see that in the middle of the month, it did dip. And so we did have this little bit of a dip, but now it's back on this upswing. And again, depending on where you get your information from, there's a lot of talks that these swings truly started and were caused by the debate, or whatever we want to call that, on Thursday. And this is why the rates have started going back up, is that there is some fears of some things that could potentially be going on, and that's why the interest rates started moving the way that they did. So again, we'll see kind of what happens with the labor market, and with seeing interest rates going back up. Again, this is the important thing that we need to be doing. We need to be keeping our finger on the pulse, and we need to be knowing what's happening in the market. And if we know what's happening in the market, then we're able to have conversations with people. We do know that while this line right here, we're in the basement, right? Like we're just peeking out. We may be looking up over the stairs right now. There are still people that need to buy, right? And so while we know interest rates are high, we know that we're seeing less people buy houses. There's still people buying houses, and I think that's the biggest thing that we need to keep in mind. Like, people still need to sell, people still need to buy. That population's a lot smaller, and those people are still probably your neighbors. They're your sphere of influence. They're your family. Like, there's someone in your ecosystem that needs to buy a house or to sell a house. And so when we're knowing this information, we're having conversations, and we're being that real estate economist of choice, and we're getting our finger on the pulse and knowing what their real estate goals are for the remainder of the year, right? Like, you might be having conversations, right? Someone's like, oh, hey, what do you do for a living? If they don't know what you do, and we have that adult conversation, I'm a real estate agent, we go down that path. If they know what you're doing, right, and you're at a party, you're doing something, they're going to ask you, how's the real estate market? And we just go through and we just figure out, like, hey, that's a great question. So then I give you the best explanation. Tell me, are you asking from the perspective of a buyer, a seller, or an investor, right? And then you know what their mindset is. It might be nothing. They might say, you know what, I heard on CNN, I heard on Fox, I saw on YouTube, whatever. Or they might say, like, hey, I'm actually needing to sell a property. Maybe they're the executor of someone's will. Maybe someone passed away in their life and they are in charge of selling the house. And we know that these people exist, and we need to know what's happening. Maybe they are looking to buy a house. Maybe their rent's coming up and they're not looking to be a renter again. And in the next 3 months, they're looking to purchase a house. And if we know this data, we're able to have these conversations and be that real estate economist choice and help them move forward. So as we're looking at this thing, yes, interest rates are going back up. But again, with interest rates going back up, there's still people, like, we can still see people are talking to your lenders and getting pre-approved. They still need to buy. People still need to sell. Real estate's still happening. We just know that it's a little bit smaller of a demographic doing it. But let's look at this thing. So we're looking at it. Here's Arvada. Here's ARRRR2 specifically. We can actually see some things trending downwards. We can see that we're at 675,000 is our median price point. I think 411 is the national price point, which is the highest on record that it's ever been. And we're sitting at 675 in Arvada, ARRRR2, specifically where the brokerage is. Their median price point of new listings, 547. So kind of interesting. We're actually seeing homes on the market come in a little bit lower now. And what this should do is it might alleviate this at some point. But what we're going to see is this number is probably going to go up a little bit higher as these numbers try to get closer in line with these. And right when we're talking about this, and we're talking and we're having this conversation, we're at the dining room table, and Mr. and Mrs. Seller are wanting to know what they should be listing their home for, and we're figuring out what their motivations are. Why are they selling? What's their timeline? When do they need to be there? What's driving them? All these different things. And we're looking at this thing and we're saying, well, the median price point in this area is 547. And we're looking at the sold prices. We're not going to list at the sold price. We're going to list it a little bit lower because just psychology of buyers at that point makes life a little bit easier as we're getting a little bit more competition. We're getting a little bit more money for the house, or else we're going to be like these guys. We're going to be chasing the market. Like these median list price of 675. These are the homes that are on the market. These are the new homes coming onto the market. These guys are going to be chasing these $675,000 homes will be chasing the 547. And this is a huge swing. And so I don't know if these are truly apple for apple, or we're putting cheaper homes on the market, less square footage. I can't tell you that. This data doesn't show it, but this data does at least show that homes are coming in on the market at a smaller price point, and it's median, right? So keep in mind, median, we're taking the lowest and we're taking the highest, and we're just working our way into the middle. Like that's what the median number is. Price per square foot, we're at 379. That has gone up a little bit. And the average days on market, we're sitting at 57 average days on market with a median of 28. So again, same kind of conversations. We're letting our sellers know that if they're going through and they're pricing their home too high, right? Here's our too high number at this point. 57 days, 2 months on market, but homes that are coming in priced correctly are sitting 28 days. 30 days on market. You're talking 62 months versus 1 month worth of data. Price decreases rolling up and up, right? We saw this historically or nationally at this point. We saw that the national numbers are going up to almost to 40%. I think it was 38. Our Nevada 8 triple lot 2 is in at 48%. Almost half of all homes in 8 triple lot 2 are having a price decrease, which merits the question, where are they getting their information from? Right? Like as we're going through and we're having these conversations, we're sitting at the dining room table, Mr. and Mrs. Seller are there. We're having these conversations with them. Their motivating factors. Why did you call me to come list your home? And where are they getting their list price from? Why is it that half of all homes in 8 triple lot 2 have seen a price decrease? This number has gone up and up. There's a little bit of a blip right here, and then it went up and up again. Guys, as being the real estate economist of choice, like at least Kim could speak to this. Like I remember, as you know, back in like even 2017, where price decreases matter. Like everyone else on this phone or on this call has not got to experience this, but there was a time where we actually had to show our price decreases. Like, and they would ask you, you'd be at the dining room table with someone, they'd be like, so how many price decreases have you done? Because they wanted to know like how good of a seller's agent you are, how good are you at pricing houses, and these numbers are going to come back to matter again. And this is why we can't be letting the seller, yes, the seller is ultimately the driver of this decision, but we need to educate them. And this number will actually come back and start hurting agents as they're going through and they're competing with listings. And they're like, yes, almost all of my listings have a price decrease attached to them. Like this will start to hurt in negotiations. Price increases. So I've been telling you guys for months now that as I'm looking at price increases, I don't care about them because these are just new builds coming to market. 0%. A triple lot 2 did not have a new build increase come to the market, right? Like we did not see any more new builds come to the market. It stayed flat. It didn't go up. This just goes to show you And we looked at this market, this information, the team rally last week, right? We went through and we actually looked at this information. Less and less new builds. Colorado specifically, we looked at Colorado, less and less new builds. We're not seeing permits, we're not seeing starts. This just goes to show you we're looking at this thing now and we are not seeing any gain. Builders are not coming in droves to build an 8 triple lot 2 right now. They're selling through their inventory, and they're selling through their inventory right now because their stock prices are going down. They're not making as much money. They don't want to be caught holding the bag. They have shareholders that they need to answer to. These CEOs, these executives, these board of directors don't want to be fired. And so the only way that they can actually boost is actually to stop producing as much, right? So as we're going and we're looking at this thing, we're finally at zero. Relist, we're seeing a little bit of a spike. And again, discerning buyers. Like, this is a discerning buyer market to where we're not seeing houses take monstrous price decreases, even though 48% in a triple lot 2 did. But what we're seeing is these discerning buyers are saying, for the interest rates and what I'm having to pay on with that money, I want to make sure more things look right to me. And then we have sellers, and if they're motivated, super motivated, they're going to make some decisions, and it's going to be a business decision. If they are not as motivated, they're going to take more of an emotional decision. And they're going to say, you know what, I'm not willing to do that. And we're going to see more houses come back to the market. 23 is just the inventory score that is given it. Median rent, 2.9. It has trickled down a little bit, and it is giving this market action report of 59, which looks like pretty much right in line to where it was last month. So we're still in the seller's market, even with interest rates and inventory and everything else that's happening. We're still there, right? We're still going through. This is a hard market. It's not as bad as 2023. 2023 was probably arguably one of the worst markets that we ever had. And this doesn't feel as bad, but what we do need to be making sure that we're doing is having the conversations, guys, because this will not last. And not only will it not last, but there's a lot of indicators that it's going to get better towards the end of this year. And so we need to be having the conversations. We need to be talking to people. We need to be figuring out what their motivating factors are and being the real estate economist of choice, knowing who's looking to buy. Is it interest rate decision? Is it that they know that they're going to be having to move here soon? Have those conversations and develop a game plan with them to win when that time makes sense.